All right, stocks continued higher, a little bit of a two-day streak. Not the first two-day streak we've seen, especially recently. So I'm going to show you how this one compares to the last rallies we've had up to 380, 3,800. Again, we did get to 3,800. That's a significant level. Did we do enough? Did we do enough today? So I'm going to break down, what these indicators are looking like now as we are sitting at this really important resistance level. Do we have enough juice here to break through? We're going to talk about that. We're going to talk about what drove a lot of the price action today from an asset class and sector rotation standpoint. Does that foretell us breaking through that resistance? So we're going to take a look at that. See some interesting patterns developing today as well in some of those areas. We got a big basket of earnings this week in a lot of these areas that should help us push through. We had a lot of economic data out this week, a very important week from that perspective to see whether the Fed sees an economy that's growing too strongly or not enough, as to whether they can continue to put the foot on the gas, so to speak, with the rates or not. And then, of course, our trade idea, very popular strategy right now because of the kind of market we're in. So we're going to look for the right kind of setup that fits that strategy. So let's go ahead and get started. Today is Monday, October the 24th, 2022. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here or the subscribe button down below the video. Also hit the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, so if you're watching us here on our blog, check out these things over here on the right, our classes over here on the right, and Market Outlook Live, our upcoming trading rooms. Come down to the bottom, click that heart. We got more than 71, so we beat Friday or last Wednesday's video, but only by a handful. Let's see if we can't push that up to 100 again. That really goes a long way for us. You can just click in that heart, then hit that like button there. Same thing with that Facebook. Click the thumbs up icon. Click that like button. You can do that right now while you're watching. I also wanted to give a shout out to Tom. We really appreciate the thanks there for the video. Again, you can do that by clicking on thanks. It opens up this tab, and you can click any amount that you want there. Hit buy and send, and that's another way to support the channel and the videos that we produce here for you every day. Okay, as always, we'll start off taking a look at the S&P with the market forecast indicator. So here's our two-day streak, and you can see after getting this bear tag on Friday, we continued higher today into this gap between that 3,800 level and the 30-day moving average. So the near-term line made its way into bullish territory again. It actually did that over here as well on this run. You had the momentum line getting up to 89.5, and then the near-term line made it to 93 the next day. Very similar to kind of what we're seeing here, except the momentum line stayed higher for one more day as we close at the high of the day. We did close. We still have the light green shading. We're rising, but we're not even above 40 yet, much less above 50. That's when the dark green shading comes in. Of course, getting above 60 is when you return. That's when we're in bullish territory. We are above the market sentiment line. We are above the 30-day moving average, but not 2.5% above it. We're still actually less than 2% there. So we're not as, this isn't a breakout bullishness. Again, just a few weeks ago, we had the same exact pattern. We were coming off of a cluster, and we had a two-day rally that got us up almost to the exact same level we're at right now, just a few points lower in just 2 days. And so in 2 days, we've come up from 36.65 versus over here in 2 days we came off of 35.85 and got up to pretty much, like I said, the same level. Of course, back then we were not the short-term sentiment was bullish. The intermediate line was more oversold. We were not above those moving average, those Fibonacci lines. We were not above the moving average. We are above the moving average this time. We're still not above those Fibonacci lines. We do have strong short-term sentiment. The intermediate line's not below market sentiment. It's above it. It's not in the lower reversal zone, but it's still in bearish territory. So needless to say, it's a very similar pattern, but there are some things that are not similar. They're different there that suggests we might be a little bit more bullish. Let's take a look at some of the other indexes. Let's take a look at the NASDAQ 100. So the NASDAQ finally got above, it got its bear tag, got above the 30-day moving average finally. but just 0.2%. The intermediate line is above market sentiment, but both are still in bearish territory. Strong short-term sentiment looks very familiar. We are above the 23% retracement. We are not above the 38 or the 23 on the long-term level. Remember the 23 and 38, these two lines, which are at 3,800 for the S&P, are a lot higher on the NASDAQ. So keep that in mind. The NASDAQ's been a little bit more bearish in that perspective than the S&P 500 has. Looking at the Russell 2000, we are also above the 30-day moving average. We did get above the bear tag yesterday. We continue, but we're still less than 1% above it. So it's hardly a breakout. We're barely above that 23% retracement level. Strong short-term sentiment, more intermediate lines above market sentiment. The market sentiment is falling, and they're both in bearish territory. So again, it's a great 2-day rally. It's got a lot of, it's got the Wattners of the world and people talking about how bullish this is, and the market's turning over, and here we go back up to new highs, right? The 2-day streak will do that to people. Kind of gets them really riled up and getting bullish again. The reality is we're still not, we're still holding resistance. And that the thing we always say here is you expect resistance to hold until it doesn't. And as of right now, you're still below 3,800. And it's obviously you have to get through all these lines. So you have to get more than just 3,800. You have to get above probably about 3,800 plus or minus a few points, right? To get eventually above the red line, which is at 38.38. But you can see these other lines are sitting right at 38, the 38.10. Looks like the orange line there is a little bit below 38.10. It's at 38.04. The black line's at 38.15. The red line's at 38.38. So you see the Fibonacci, the green line there is at 38.10. So you get an idea that they're all kind of in that area, not exactly at 3,800, but pretty much. 3,800 is the resistance based on that level, and of course the getting above 2.5%. You'd have to get above those lines to get above 2.5%. You'd have to get above those lines for the green line to get into bullish territory. It's one thing to get into this neutral territory and then turn back down. But that's happened multiple times, and I believe it's going to happen again here. All these times, the 2 of the 3 times we got above the market sentiment line while it was in bearish territory. Like it's happening right now. Actually a 4th time right there. But the reality is, and we got above the moving average there. We did not get above the moving average here. We barely got a little bit above it there, but hardly at all, right? Just 0.07. So we're not, this is another instance of that. And again, a bear tag will either lead to a renewed leg to the downside, like I think we're going to get, like we did here in June, going into June expiration. Or we're going to start a new bullish rally like we did here in July and August. So it's not, you don't typically get these bear tags when you're just kind of going sideways, right? So especially with short-term sentiment as strong as it is. It suggests that we could be breaking out, but we haven't broken out yet. And when you look again at some of the confirmations that think, okay, well, we should, we're above this October 4th peak. We should be above it in volume too, right? But here is the October 4th peak, and you can see where we're at. Well, here, let's take a look at SPY. Here's the October 4th peak right there, and you can see where we're at on the actual volume itself. So we're still not getting strong confirmation. We're above this level. This is the volume level that we had on 9/21, and again, we are not anywhere near that. Even though we are above it on price, we're not anywhere near that on volume. When that volume is normalized by the price, right? This is the money flow. So it's not surprising that volume wouldn't be higher, but when it's normalized, it should be, right? It should be above that level. There should be as much bullish volume as there is bearish volume when we're trying to form a low point. That's not going to be the case as you rally, but it is going to be the case when you're forming a low point, and it wasn't the case back here, and it's not the case again. So we're very susceptible to that level. I mentioned before all the other corrections. On all these other corrections, when we do get above, let's see here, it'd be it doesn't have it drawn on here. Let me draw the Fibonacci, the year-to-date Fibonacci lines. So on all the other corrections, which we presume that this would be, if we're going to hold this 3,500 and rally, that the presumption is that then it's a very deep and long correction, one of the longest, as you saw in Friday's video, but still just a correction, right? If we were to hold this and really get going, that means we have to get above 414, this 50% retracement level. And again, when we were above when we crossed below 414, back over here, you can see where the volume was at. So that's where the volume needs to get above if we're going to confirm the correction, right? Because it got above it over here, but the volume didn't, and hence the fake out. All the other corrections I showed back then, there's a tweet I posted back here. All the other corrections did have that. When you got above the 50% line after being below it, the volume was at least equal, if not higher, on all the other prior corrections. So it's a sign that correction's not. And so same thing here. You can look at it from the same perspective on the current intermediate decline, right? When you drop below that 50% level over here, that's where the volume was. That's where we need to be if we're going to get above 390, because that's going to require a big breakout. If we're going to get above 390, the volume needs to get above that zero level. In this case, the unbalanced volume, for us to feel good about a breakout. And as of right now, it's not pacing for that, right? Because we're not. This is where we're currently above the high point again on 921, and we're nowhere near that level on the volume. Okay, let's take a look at some of the other charts here. Let's start off with the weekly chart. And again, we got the green arrow now. Again, this is only one day in the week. We still got a whole four more days left. Regardless, that's a good candle pattern. Obviously it's a reversal. We're closing above that body easily. We're closing above the high. It's a very good reversal pattern here if it holds, especially with the green arrow, the rising PPO, the positive differential down there. Very good pattern if it holds. 3 green arrows for a second day, very good sign. 5 days on the Dow. If we can get that over here on the S&P, very, very good sign. We finally got 1 day on the NASDAQ. We've got a second day on the Russell, 2 days on the S&P. It's got to hold. It's got to be more than just 1 or 2 days. It's got to be 5 days. And so, and getting above that 2.5% mark will help solidify that. And as of right now, still not, still only a couple of days. So, let's hold this tomorrow. Let's hold this on Wednesday. And let's get 2.5% above the 30-day. Then we're going to feel really good about an extended run, right? A good intermediate rally. Those intermediate rallies, someone said, why am I always like either we're going to be bearish or we're going to be bullish? Because when you're below moving averages, you get your biggest moves to the upside or the downside. We're below moving averages. That's number one. Number two, when you're starting a market sentiment rally to the upside, when the market sentiment line starts up and gets in bullish territory, when you're starting a market sentiment rally, it starts with the biggest intermediate runs. That's by nature, again, if this is the first intermediate run of a bullish market sentiment rally, it's going to be a really good move. This one's a pretty decent move, and it came really close to starting, right? We had the fake out. It came really close to starting a new market sentiment rally. It didn't with the fake out there. But it's, the first intermediate run of a bullish market sentiment rally, the orange line being the market sentiment line. When the market sentiment line gets above 60, that's your run. The first intermediate line, the green move, it's a strong one. It lasts multiple months. It makes a good run to the upside. So that's why this 3,800 is really important. Getting above this level, getting above all these lines, getting above 2.5%, getting those signals that we've been talking about will be a really, really good sign. Getting above 25 on the positive index now that we're below 25 on the negative. Right, we need to see that. We're not even above 20, much less above 25. Right, getting above 70 on the RSI. Since we've been so bearish, you got to get above 70, and we had that here, but again, hence the fake out. But you got to get above 70 to reverse a bearish trend, and we're not even above 60. All right, why to get above 70 there? We need to get above 150, if not up to 200, to really solidify this bullish move, the bullish beginning of this market sentiment rally. We're barely above 100, so we're okay, but we're not. This isn't super strongly bullish. The rate of change has got to be positive, which means the red line's got to be above the price. It's not. It's still below the price. We are above the blue line. The green line's not, but this is above the blue line, and we don't have a trend anymore. So the bearish trend is broken, though we're still easily below the cloud. So those are things we need to see. We need to get above 100 on the Bollinger Bandwidth. We got above 75, but we got to get above 100 if we're going to break out of this kind of this squeeze play where the bands got inside the Keltner channels. We got to get outside of these, and we're not. We're just barely above 75th percentile. So I mean, these are good signs. You have to work your way there, and as of right now, we are working our way there. The stochastic indicator I've shown you before, is easily above 85. We see it got above 85 before and failed. So that's not in and of itself why you've got to get this orange line out of bearish territory and into bullish territory to feel really good about the turn. You can see we've been looking at the intraday highs and lows and talking about getting a new 4-week high. Well, we did. We got a new 4-week high today. That's a very good sign. This is a bullish breakout on the Arun indicator. You got to break above 100 with the red line below 70. That's a bullish breakout sign here. It's a very good opportunity to be bullish on this indicator. Now we need to hold this, right? We had a higher high and a higher low. We easily closed above yesterday's high. We got to, we're above last week's high. We got to continue to hold that up here to the upside. It's a very, very good sign there, and a very good sign on the Arun. And you can see the hull is bullish, right? We got a good, after kind of a lower close, and the body's not really doing. We did get a close above the body, though not above the highs on Friday. Well, today we did, right? We got a good close today. We closed above all these highs. The parabolic star is way down here. The hull is moving up strongly. We're still below the 200-day hull, but you've got our, we're getting closer. We're getting closer to being bullish here on the S&P. We really need to break. We need this earnings season and all the economic data, including GDP and employment cost index that's coming out here. That needs to all be really good, right? Actually, it needs to be really bad, but so that the Fed will stop raising rates, and then the stocks can be really good. Talk about a divergence between Main Street and Wall Street. Like Wall Street really wants Main Street to suffer, so that Wall Street. I mean, that's kind of what we're hoping for, so that we can get a good rally in the markets. But it doesn't matter why. It doesn't matter what drives the markets higher. All that matters is that what drives sentiment, bullish or bearish. And right now, that's kind of what you need to drive bullish sentiment, to get people willing to buy stocks, pushing you through these technical levels, technical resistance levels. So we got some good opportunities here. The VIX, we take a look at the VIX. It came down, but it always kind of rises on Mondays. But it came in and filled in that gap. It's down. It stayed below 30. Right, we closed Friday below 30. It closed below 30 again. We're below 100%. We're not breaking down though. We've been really stuck sideways in this. But you notice again, the VVIX came down again, right? So we're down to 86 now on the VVIX. It's a really, really low level for the volatility of the VIX, relatively speaking. If I were to go out in time here, so you can kind of see, this is a relatively low level, much lower than what we've seen here for most of this year and pretty much all of last year, even though 2021 was a relatively bullish year. In fact, we were insanely bullish by the beginning of this year. But for the VIX to be above 30 and the VVIX to be at 86 is a pretty decent divergence in the very, very short term. And the fact that the VIX is not falling sharply relative to the VIX 3M and not really falling sharply at all on an absolute basis either suggests that it's kind of holding up for something. Is the VIX going to crash down finally and catch down to the VVIX? Or is the VVIX going to jump up, which it normally does after the big week like it had last week, and will the VIX go up with it, right, considering they're typically very high correlation? It seems to be the latter is the scenario because it just won't drop. It won't drop on an absolute basis. It won't drop on a relative basis, despite the fact that the VVIX says it should be dropping pretty hard, right? The VIX should be dropping on the move from, over the last couple of weeks, pretty much from 110 all the way down to 86, the VIX should have come down pretty hard with it. And, it came down some of these days, but, it's come down from a high of 34.5 to being just a little bit below 30, but that's not much of a drop considering how far down the VVIX is, right? So when you look at the VVIX, we are near these lows that we had in early to mid-August. But when you look at the VIX, we're nowhere near the lows of mid-August. We're nowhere near those. So again, it suggests like this hasn't dropped like the VVIX says it should has. So if the VVIX were to catch back up, which you expect it will, then it will probably bring this up with it. All right, now let's take a look at what's driving the price action today. And you can see it was pretty much limited to large cap tech names. The QQQs pretty much being the only thing up more than 0.5%. Global bonds being the second highest. Commodities being the third highest. I mean, nothing really gained. IWM was pretty neutral, as you can see, down up about 1/3%. Bonds were down, but spent most of the day pretty flat. Finished the day down 0.75%. So yield finishing higher again. The dollar was up a little bit, as you can see right here. Emerging markets getting hammered. China really getting hammered more than anything. So they have been in the bear market, so it's not surprising. But it is interesting that, again, you look at EEM here. It's still it's been in the bear market for quite a while. If you look at where it's so far below the 50-day, 200-week moving average at the 50-week is crossed below. You're below the 5-year point of control or value area, and you're breaking down below that 78% retracement of the post-COVID rally. Remember, the S&P is sitting right at that 38%, trying to get back above it, whereas the emerging markets are below the 78%. You look at EFA, they are below the 62%, and also below the value area of their 1 year. So it's international equities are really struggling, and so not surprising to see that they're still down on the downside. What is surprising is to still see long-term bonds maintaining last week's kind of blow off top type move. That's a big decline. It's a big range in 1 week. But it's only 1 day. It's less than 1%, so it's not that. It's a very small range. The PPO now is lower than it was here in May. So again, this is the most bearish a TLT literally has ever been. Right? If I were to go to this is the ETF. Obviously, it doesn't have all the history of the government bonds, but for the history of this ETF, which started back in 2002, so about 20 years of history here roughly. This is the most bearish that bonds, the TLT has ever been, including, the post-2008 great financial crisis, including here coming off of the, this QE3, coming off the credit crisis when it rallied, then you had QE3, and then of course some of these other levels here, the election in 2016. These are some big declines, some big momentum moves to the downside, and then the post-COVID. But this is the biggest, even earlier this year, but this is the biggest here as we continue to trade. We're even down below the 20-year value area. And if you look at a linear regression for TLT over the course of its history, so roughly 20, well, let's just go 20 years, you can see that it's easily below its second standard deviation channel, which is pretty rare for bonds to get outside of any standard deviation channel, much less the second one. So I mean, that's a big move. It's below 100 now. This is as high as it was with COVID, and the ATR relative to price, or the range, is as high as it was at COVID. It was as high as it got in the great financial crisis, when it really took off to the upside and then came back down. You had a big volatility there in the bond market, where you're getting a lot of volatility again. This time, again, like I said, 2 standard deviations away from the 20-year rising linear regression trend line. Let's take a look at some of these other markets. So I showed you, I haven't shown you this chart for a while, but China was the big loser today, down 10%, FXI down 10%. You can see Japan and Korea are also still down, dark pink shading and a red line. So remember, Korea is a reflection of global economic growth expectations, because of what it's a proxy for. So it's, you can see we're not necessarily, even though like Europe is looking pretty good and the UK is looking pretty good, India is looking pretty good. All light pink or light green shading and yellow line. And a big drop today too in Brazil, coming back down to a rising moving average. But the fact that Japan, the world's third largest economy, and Korea, a proxy for the global economy, are still dark pink shading and a red line suggests I probably shouldn't be too bullish about this. With what we're seeing in the U.S. and in Germany, in the U.K., as we're not really seeing that broadly speaking across other major elements of the world's economy there. Let's take a look at the sector moves, and you can see the sector grid 2 to 12 grid for all the different sectors. And again, light pink shading and yellow line for pretty much everything. Not quite for discretionary, which, again, a lot of ties there to China weighing down on that. Utilities and real estate still really struggling with the rising interest rates. Dark pink shading and red lines there. And you can see healthcare and staples. Everything pretty much light green shading. Energy is the only one. And energy looks poised to really kind of change the direction here. If you take a look, if I were to go out, zoom out a little bit, you can see of this decline that we had from its peak in June to that low point in mid-July. We are trying to get, we had pulled back here. We had started to rally back up and started to retrace this bearish move, because this bearish move got you below these lows, right? So now the question is, are we going to break back above 78 and renew a bullish trend, or are we going to get back into retracement mode? Again, remember, the story here is that commodities are going down, right? So the fact that crude oil is still, kind of finding a base here and not going down anymore, and is more prone, at least there's more risk of a move to the upside than there is to a downside. Again, that doesn't really help the narrative, right? This inflation narrative. Of inflation moderating because of falling commodity prices, inflation moderating, and then the Fed pausing on their rate hikes, at least slowing down. Like that, someone said today that's the new Fed pivot is, now it's not so much the Fed's going to cut rates, because that would be the pivot. Now the Fed pivot is that they're going to slow down the hikes, which again, it would be unprecedented. They haven't done that since the 70s, which is the policy error that Powell famously noted in his Jackson Hole speech this summer. So that he did not want to repeat, and that they were going to instead raise rates and keep them high longer. So the fact that we kind of still don't believe him shows the credibility issues that the Fed is dealing with from a market standpoint, and why, why the market keeps rallying on any sign that they might not do something. It goes to show that maybe they don't have quite the control of inflation that they think they do. All right, let's see here. I wanted to look at one more sector move here just today, and you'll see, energy holding up its gains, but discretionary was the biggest loser today, and you can see that pretty obviously here. It did rally by the end of the day and kind of caught up off of its lows. Materials came down, interestingly enough, even though the dollar didn't really rally that much. Real estate was down, even though yields finished near their highs of the day. The utilities also kind of underperforming because of that move in yields. But real estate was down when yields weren't up so much. And then finally, you can see our biggest winners today are healthcare and staples, right? Financials and industrials, technology trying, but healthcare and staples. Well, remember, the Qs were the one asset, the equity index that outperformed the most. The diamonds did too, but it's interesting that the Q, like XLY and XLC, underperformed pretty dramatically. They were down here with energy, which has been a leader lately, also underperforming. So again, not quite that bullish leadership that you're looking for to break key resistance levels, right? You're going to need to see XLK, XLY, XLC grab arms with each other and break through that wall to really get you going. They're the generals. They're the big dogs. They're the ones that have their earnings coming out. So they've really got to band together and break that wall of resistance if we're going to hold through. We don't necessarily want to see industrials and financials get together with staples and healthcare and say, hey, let's really lead this market higher, because they're kind of the role players, so to speak. The guys that don't do a whole lot. The smaller weighted sectors in the S&P 500. All right, as has been the case here lately, the strategy du jour is still, because we're not trending down right now, but we're also not trending higher, is to look at stocks that are kind of sideways and flat. And you've got, Mosaic here, where it's market sentiment lines in neutral territory, it's intermediate lines in neutral territory. You're barely above the 30-day moving average. I mean, that's about as neutral, and you're inside of the Fibonacci retracement zone. You're about as neutral as you can be. You've got all this different shadings, right? We're not dark pink, we're not dark green, we're just flipping back and forth between shadings, which is a sign that you're not really trending one way or the other. Very, very neutral. You can also see that too showing up in the ADX line being well below 15. Neither positive or negative indicators are above 25. So nothing's really going there. The Ichimoku cloud, you can also see there's no trend going on here as well. When you look at the Bollinger bandwidth, the bandwidth is about as low as it's been all year, and we're not breaking out of it one way or the other. If you look at the moving averages, you are above the 30, trading between the 30 and the 50, but you're still between the 200 and all these lines, and you're sitting right at the point of control, right smack dab in the middle of the value area for the whole entire year. So again, about as neutral as you can be. When you look at the long-term chart here, I mean, look how the PPO is just less than 1%. It was pretty high. Now it's practically nothing, and you've got multiple dojis in the Hakinyashi candles. You got a good bullish candle this week, but you're not closing above the highs. So when you got a very neutral setup like that, of course, the strategy to take advantage is that iron condor spread. So we're going to go out and do the 60-65 here. The 60-65, so $5 wide spread. We'll come over here and do the 47. So both of these short contracts near the low 20 deltas, going out $5 wide, doing a full position size, even with earnings coming up, because we're not really getting that much return for that. So this is a pretty normal return for an iron condor spread without earnings coming up. So the fact that you have earnings coming up means that the market really doesn't care too much. There's where the break-evens are here. One's at the 38% retracement, that old peak. So you got some resistance up there holding it. The other is, here, let's pull up this chart. The other is, so there's that one. We've got a volume node right around 60. The other is down here at the lows. You got a volume node down here too at the bottom of the value area. So as long as we stay in between these nodes right around the middle, then that's how we make our money. And you can see you also have the 78% retracement. So to break either one of these break-even lines, you'd be trending one way or the other, and that we want to be out of this trade if we start to trend one way or the other. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Also, join our website at marketscholars.com for free. Like us on Twitter and Facebook. Have a great rest of your Monday night, everybody, and we'll see you all next time.